Hey everyone, and welcome to Talk ETFs, ETF.com's weekly video series. I'm Sumit Roy and I'm Senior Analyst here at ETF.com. Today I'm speaking with Matt Camuso, ETF Strategist at BNY Mellon Investment Management, which has $452 billion in assets under management. Matt, great to have you on the show.
Great to be here. Thanks for having us.
And of course, BNY Mellon has 9 active ETFs on the market today, if I'm not mistaken. Are there any that have been particularly successful that you want to highlight, Matt?
Two come to mind, especially again for the market environment we're in today. The first is our concentrated international equity ETF, which is ticker BKCI. So BKCI is a bottoms-up, fundamentally built portfolio of 25 to 30 stocks across the international equity space, really looking for companies that have a sustainable growth business model. So they've seen growth throughout different types of market cycles. And the investors here, our investment firm, Walter Scott, really puts a keen eye towards quality. So looking at the balance sheet, making sure that net debt to equity is going to better or more attractive than the rest of the options in the broader kind of universe, here being the MSCI EFA. And if you just look at the inception performance, so inception through Q3, BKCI has actually delivered about 185 basis points of better performance relative to the MSCI EFA growth index. So an ability to get more of a growth exposure in the international space, but again, with that kind of fundamentally driven active approach, looking for those kind of more quality growth type names. And the second is our global infrastructure income ETF, which is ticker BKGI. I think BKGI is really interesting right now, again, with the macro backdrop we're seeing, because infrastructures historically have a positive correlation to inflation expectations and just a more defensive kind of nature broadly from an equity perspective, given the kind of stable cash flows infrastructure businesses have, but also the inflation-linked contracts that are baked into their businesses. What I think really is unique about BKGI, though, is its dual mandate. So it's provide you exposure to infrastructure, but also deliver a 6% or higher 12-month forward-looking yield. So for those investors that are still very income sensitive or want that higher degree of income, BKGI can deliver on the income component, but still give you a more defensive nature because of the infrastructure exposure that the ETF targets.
Matt, you talked about some pretty nice performance numbers for those two ETFs, but from a broader perspective, where do active ETFs fit inside of a portfolio? Because I know a lot of people listening are used to index funds and they look at things like the S&P SPIVA report and they see the struggles of active funds versus passive funds. How do you respond to that?
It's a great question, Sumit, and I actually grew up in the ETF industry 10 years ago, so I'm very familiar with, passive here, active there. And I would point to the conversations really shifted in recent years. Historically, it used to be a conversation with clients of, do I go active or passive in this part of my portfolio? Well, no one ever told us we had to use one or the other. And recently, it's been much more of that blending of active and passive within inside each part of the portfolio, that more core satellite approach. So going core beta, but then satellite with an active manager. But that active manager it's more of an outcome oriented strategy. So whether they're providing you more income or lower volatility, it's how does that active strategy really diversify or complement that passive exposure? You mentioned SPIVA, very familiar with that. It's a part of a lot of our conversations, but I think actually the SPIVA report backs up what I just said of it's not just performance based, it's how the two can fit together inside the portfolio. I looked at the most recent SPIVA report, and once again, US large cap has a more challenging number associated to it. If I look at the 5-year number for US large cap, 86% of funds underperformed in the US large cap space. But interestingly enough, if you look at active ETF flows year to date, US large cap equity is by far and away the leader of flows for active ETFs, proving that it's more of an outcome oriented story because these products that are gaining flow are more income or more defensive in nature. Again, proving that investors are using these as the core satellite, kind of core passive for US large cap, but then complementing that with a more outcome oriented active manager in the same category.
Fantastic. Well, Matt, we're going to have to leave it there. Really appreciate you taking the time to share your insights with us.
Sumit, thanks again for having us. This was a pleasure.